I've been in the business for 19 years now. I am
Getting old.
Yeah, I started out in the business in 2000. I graduated from Boston College, where I majored in finance. I started out with Morgan Stanley right out of school about a month after I graduated. I moved my practice from Morgan Stanley to UBS in 2007, and I was at UBS for a number of years. And then now moved on from the big corporation to creating my own firm in Penta Wealth Management. Penta Wealth Management, we can draw upon research from multiple firms, Jeff. So it's what I like to call open architecture. So, instead of having research that comes from just one firm, formerly, as you know, I was with UBS Financial Services, where, it was really just research from one firm. And, sometimes that one firm is right, and sometimes they're wrong. So now the open architecture style, it's purely objective. We can draw upon research from multiple different firms, and what makes that unique is, we're not going to be influenced or biased, by the big corporation, and we're going to get objective, objective research that allows us to make more informed decisions for our clients. So we can then synthesize synthesize that data, and then develop what I like to call a consensus of what we think all those research firms are saying and what we think that the right move is for our clients across the board.
We manage money for families. We do full-scale comprehensive financial planning, but we also manage the money. So we do all of the, from asset allocation, investment management, portfolio construction. We also work with a lot of business owners, entrepreneurs, and corporate executives, and we help their businesses as well in a variety of ways, depending on what they're looking to accomplish for their company. Activity and deal flow has been, very, very high, very active in the last couple of years. If you talk to, some of the investment banks that are in our network, like Capstone or Covington, their activity level and deal flow level has been, increasing over the last couple of years. In terms of trends, we have a lot of software, technology, mobile device app companies that have just been, that area has just been really blowing up over the last year. So that's just in terms of industry. That's an area that we've been spending a lot of time in. What you're seeing in the private wealth space for asset management anyway, I think is really investors looking for ways to be able to outperform the market with low volatility. Obviously, that's the ideal. Be able to grow your assets, but with less, at least amount of risk possible. So seeking active management, active management strategies that can help to efficiently grow your assets while protecting on the downside. So we utilize, actively managed portfolio strategies, not passively managed. I think a lot of wealth managers focus just on private wealth management, financial planning, investment management, which is a big part of what we do, but they don't necessarily get involved with the businesses, the companies that their clients have. So for our practice, what we found is the planning that goes into the planning for the business often ties into their personal life. If you're a business owner and you're doing a succession plan for your business, that ties into your private wealth management planning needs as well. So we started to get very actively involved with helping the companies, the businesses, as well as the individual personal wealth management. The planning that goes into the business and the succession planning for that business often ties into the business owner's personal wealth management planning. So I need to help them not only for planning for their business, but also for their personal wealth management planning situation.
I think most investors are concerned about their portfolio. What do you think are the most important things people need to look at for 2019?
Yeah, so I'll give you a few. There are obviously several, and you could dive pretty deep. But at a high level, the Fed would be one. What is the Fed going to do? There was justification behind their rate hikes last year with the economy growing, companies growing, and the Fed did raise rates, as we all know. So I think that the concern on Wall Street is that the Fed doesn't raise rates too quickly and too aggressively.
Right.
So that's a concern for 2019. As long as the Fed raises rates slowly and gradually, in a controlled fashion, and as long as there's no surprises, to both Wall Street and the economy, things should be okay for the market. In other words, that it shouldn't have a huge negative impact as long as the Fed does what we think they'll do. Another area of focus for us, and the message that we send to our clients, is just focusing on the fundamentals that should drive the market. Meaning, there's a lot of noise out there that can get people excited, whether it be, trade wars and China and Trump and politics, and which is all important to consider. But the most important driver of the market over time are the fundamentals. So PE multiples, corporate earnings, healthy balance sheets, and all of that looks pretty good. The GDP growth, looked good. The jobs report that came out at the beginning of the year looked pretty good. So we expect that the markets, and this leads to another area, is what will the market do? So, for 2019, I think a concern for a lot of people heading into this year is the stock market. In particular, because there was a sell-off, as we all know, at the end of the year, where half of November and most of December, the market was down quite a bit. So a lot of investors were concerned, is this the start of a new bear market? I can't tell you how many clients asked me that question. We don't think so. We think at least for the first half of the year, the markets, the stock market will be up. And then we'll have to see at the second half of the year, what the market does. But at least for the first half of the year, for the next 6, maybe 8 months, the market should be more up than down. And then lastly, an area of focus for us is asset allocation. So even if the markets do remain choppy, even if the markets do remain volatile, there are always pockets. We call it market dislocations, and we want to take advantage of those dislocations in the market. Asset allocation and the proper optimal portfolio weightings in each of these different pockets, different asset classes, subclasses, and sectors, we can actually still do pretty well for a client if we are properly weighted in the right areas. So that means overweighting the areas that we think have more upside. It means underweighting the areas of the market that we think will have more downside.